up, guys? It's Cash Flow Cart. Today we are talking about SCHD, and I will say this: I feel I address SCHD a lot on this channel, but being a dividend growth investor, it just kind of makes sense. Obviously, in this dividend growth investing community, there's a lot of people who, push SCHD. They preach that, they need SCHD and nothing else. Or maybe they say 50% SCHD, 50% QQQ. I've seen, 80% SCHD, 20% VGT. If you guys have been with me, I personally do not hold any ETFs, including SCHD. I think there's a much better way to dividend growth invest, and that's by, identifying undervalued dividend growth stocks. Identifying attractive metrics in these growth stocks, and then building out a position in them when they are undervalued. Okay, with that being said, I do want to say this is not, I'm not saying I'm right. The SCHD guys are wrong. I'm just, I'm telling you guys my thoughts and kind of how I go about things. I've got my chart pulled up here. You can see I was a shareholder in SCHD last year. I had 6 shares, and I had those shares on for not even a month, roughly a month. I guess at this time I kind of was in a phase where I felt that I was very busy with school, and I felt that I just didn't want to put the time into pick stocks. However, I feel I snapped out of that very fast, guys. We're going to go over why SCHD is not the best way to dividend growth invest, especially in markets like this. So let's get into it, guys. Real briefly, I know we've done this before, but I do think it is important to, talk about what is SCHD. Okay, so, on SchwabAssetManagement.com, we have the Schwab U.S. Dividend Equity ETF, guys. SCHD. The total expense ratio on this one is only 6 basis points. Obviously, I think that is the lowest you're going to find. You're not going to find a cheaper ETF than that. But what is the objective for SCHD? So their goal is to track as closely as possible before fees and expenses the total return of the Dow Jones U.S. Dividend Index. I do want to bring this up, guys. A lot of you that seem to think that SCHD is some holy grail, I think it is important to note that, on a 5-year basis and on a 3-year basis, in terms of price return, SCHD has underperformed the S&P 500. And you're probably going to say, oh, that's price return. Well, let's go ahead and edit these metrics, and we are going to go total return. Okay, so does that make sense? If you're a dividend investor, you're probably focused on total return, which includes price return and dividends reinvested. Let's look at what this looks like here. On a 5-year basis, SCHD has still underperformed the S&P 500 with dividends. So I get it. SCHD is kind of a very beginner-friendly intro to dividend investing. And if that's the purpose it serves for you, great. But let's not lie to ourselves that this is some holy grail, perfect ETF. The performance looks even worse on a 3-year basis, which is honestly quite surprising. You would think with a lot of the drama we've had in the past 3 years that more of the value play in SCHD would outperform in that time, but it has not, guys. Okay, so, getting back to the fund. So it's a straightforward, low-cost fund operating or offering potential tax efficiency, and it can serve as part of the core or complement in a diversified portfolio. Guys, I understand this. Me personally, I've never really been a fan of kind of creating this diversified portfolio of ETFs, because to me, if I'm going to pick an ETF, why do I need multiple? I know that sounded kind of surface level, but an ETF in itself is already, a diversified investment vehicle. We're going to look at SCHD. It has 103 holdings. So do I need to further diversify with more ETFs, more complexities? And basically I don't want to diversify my portfolio to the point where I can't even keep up with it anymore. Okay. And that's what I think a lot of investors fall into with SCHD. They have drilled into their head, I need diversification. But, at the end of the day, they can't even keep up with 103, individual positions that they have exposure to. So, like we said, it tracks an index focused on the quality and sustainability of dividends. We will visit, the methodology here behind that quality and sustainability. And it invests in stocks selected for fundamental strength relative to their peers based on financial ratios. So, yes, these are the highlights of SCHD. However, we do need to understand that these are more likely the highlights of the Dow Jones U.S. Dividend 100 Index. Okay, so SCHD is going to do the best job it can to follow along this index, which obviously we will look at, guys. But, let's scroll down and look at some of the fun details. The previous market close, SCHD was trading at $78.10. That is as of today, Tuesday, May 28th, 2024. I did want to show you, beta versus benchmark 3-year. Its beta is basically 1, so it's going to have very similar volatility to S&P 500, which I'm under the impression a lot of investors in SCHD think it's going to just minimize volatility. That is not the case. It's going to be very similar to holding something like SPY in terms of volatility. And let's look at their holdings, okay? And we are going to come into kind of, why this doesn't work for me, okay? So here we have the top 10 holdings of SCHD, starting out at number 1, TXN. That's Texas Instruments. They make chips, they make calculators. I'm sure you guys, if you've ever been in school, you've used Texas Instruments products, or you probably have one of their chips and one of your appliances, and you don't even really know. AMGN, Amgen, that's 4.34% of their holdings. Next up, Lockheed Martin, LMT. Next up, Pfizer, guys, at 4.2% of the holdings. If you've been keeping up with the channel, I have been a buyer of Pfizer. So I guess I do appreciate seeing that one, that high in their holdings. However, for my personal risk tolerance, I'm a 22-year-old. I'm okay with overweighting positions that I see value in and I see, potential for free cash flow growth and dividend growth. I'm going to overweight my Pfizer position more than this 4.2%. Does that make sense? Now, maybe if you're in retirement, it's a little different story. You don't want one stock being more than, 4 or 5x% of your portfolio. But for me personally, as a 22-year-old dividend investor looking to, grow my passive income year after year, identify great opportunities at, undervaluations. If I see value in Pfizer, it's going to make up more of my portfolio right now, okay? I'm comfortable with taking that risk. And, just to kind of give you guys an idea of what my Pfizer position is like. Again, this is a little bit of a tangent, but okay, so I have 216 shares of Pfizer, right? It's currently trading at $28.30. Here, let me move this so you guys can see it. So, my market value in Pfizer is $6,113 roughly, guys. Okay, so for me, this position, this market value of over $6,000 is making up, let's see what percent of my portfolio. This portfolio is roughly $56,000 right now as of the filming of this video. So my Pfizer position, as I'm building it out, is, almost 11% of my holdings. Does that make sense? And I'm okay. I can sleep fine at night knowing, with my risk tolerance, I'm comfortable with having 11% of the capital in this portfolio in that Pfizer position. Okay, I guess in a nutshell, that's one reason I can't get behind buying SCHD, because if I see an attractive stock, I don't want, a maximum of 4% exposure to that stock. If I see an attractive stock, I'm trying to build that position while it's attractive, while it's undervalued. And, hopefully as Pfizer kind of completes this reversal here, that 11% is going to, essentially go higher. We could see it 15, 20%, and I'll still be okay with that exposure, because at this point, I'll be moving on to other holdings. I'll be building out other positions. Okay. So, that's kind of a brief tangent, but again, I want these videos to be very real, very conversational. I want to show you guys how I do this as an investor. I want you guys to see, inside my brain, whether it's right or wrong. These are my philosophies. This is how I go about portfolio management and, my investing decisions. Next up, guys, PepsiCo, PEP, Chevron, Coke, Verizon, Cisco, and then lastly, BlackRock. That's the top 10 holdings. And I do want to illustrate another point, similar to what we just talked about with Pfizer. If I see Pfizer undervalued, I'm buying Pfizer shares, okay? I'm not looking to enter into SCHD, which is, essentially trading near all-time highs, okay? Because while I am going to get that exposure to Pfizer, I'm not going to get it, in a meaningful chunk. And then let's say Pfizer does return to more of a fair value, SCHD is going to go ahead and rotate it out of the portfolio. Okay, so I can't really build anything with SCHD that is, an amazing yield on cost play, guys. Does that make sense? I can't get the exposure I want to get to these undervalued stocks. And, if I do get in a play, then eventually it's going to be rotated out of the portfolio kind of when it returns to its fair value. And that doesn't sit right with me, not to mention, I know we said it was a low expense ratio for this one. However, I put too much time into this game personally to pay any sort of expense ratio. Okay. And that's maybe that's me being stubborn, but for that reason, and at this age, I'm not interested in paying, Schwab or Vanguard. I'm interested in learning this game on my own, learning how to manage my portfolio in a way that makes sense for me. Okay, and we'll talk about that a lot on this channel. Every investor in this community, guys, we're all different ages. We all have different risk tolerances, and we all have different goals and aspirations. So again, without going too much on a tangent, I do want this to be a community where we kind of encourage bouncing ideas off each other and kind of sharing, okay, here's how I do it. Here's why I do want SCHD. Okay, so, we're going a little overboard, but let's get to this example. And we'll talk about this. Something with 103 holdings like SCHD. Let's talk about why you can never really get to outperformance of the market. Okay, you can never really get to a point where you're doing much better than the S&P 500. You're outperforming. You're developing your own edge. And let's talk about the why. Okay, so we see the number one holding, Texas Instruments, TXN. We just mentioned, guys. Let's go ahead and pull up the chart for TXN. And in recent times, I haven't really dug into Texas Instruments. I've had it on a watch list, I believe, but I haven't necessarily, looked in detail at it. But just from looking at the chart, what do we see here with Texas Instruments? Okay, it just hit an all-time high, this week, today, I guess. We'll pull up the intraday chart. Yeah, so Texas Instruments hit an all-time high literally this morning. We had that long weekend with Memorial Day. Market opens today on Tuesday. Texas Instruments is hitting an all-time high, guys. So with that being said, if I'm looking to buy SCHD, I'm going to get exposure to Texas Instruments, okay? because it is that number one holding in SCHD. And for me personally, if I'm interested in having exposure to Texas Instruments, it makes much more sense to kind of wait and to watch it, and, you know, in the meantime, focus on building out other positions, okay? Locking in, you know, better starting yields and being a little more opportunistic with my capital than just, you know, buying something that has 103 holdings in it while, you know, a lot of those holdings are essentially hitting all-time highs. Okay, it doesn't make sense to me, and that's kind of my take on it. Another thing we will go over, and I do want to mention this, I don't see myself buying SCHD, but if I were to buy SCHD and add it in the portfolio, I think I would have to get, you know, a pretty historically impressive dividend yield from it. And times when we're going to see that is like, what is this? You know, March 2020, guys. What happened in the market? It crashed. And with that being said, we saw, you know, a very high dividend yield in SCHD of 4.4%. You know, maybe then, you know, that high of a dividend yield would be worth kind of me just capturing that diversification. However, when we don't see too impressive of a dividend yield in SCHD, I'm simply not interested in it. I'm more focused on searching for other opportunities, guys. Okay, now we're kind of going to move into, I guess, the conversational piece of this video. And I think there's three kind of main points SCHD buyers bring up. And I have kind of prepared those, written those down. Let's get into it. So stock picking leads to being under diversified. Okay. I understand this, but I do kind of want to offer my rebuttal on that take. And it's this. Okay. As a dividend investor looking to build passive income that increases year after year, because, you know, guys, that's what we're doing here on this channel. I understand this is a long-term game. It takes time. It takes patience. And with that being said, you know, my diversification is going to come, you know, as I identify attractive plays, undervalued, and I build out those positions, okay? It's going to come year after year, okay? I don't need 103 holdings in my portfolio right now, you know, maybe never. But, okay, by the time I'm 30, this portfolio will be more diversified. By the time I'm 40, theoretically, it'll be a little more diversified. So I am going to find that diversification. However, it's not going to be an instantaneous thing. It's going to take patience, and it's going to take kind of a long-term conviction. That's my rebuttal to that point. I don't, you know, only having 8 holdings in my portfolio right now, I don't feel under diversified. Okay, this is like we said, this is roughly a $56,000 account, and, you know, you spread $56,000 across 8 holdings, and, you know, you don't have like huge positions per se. Okay, moving on. Stock picking takes too much time. I guess I get this. And I guess my rebuttal for this one is I really love this game. I like to put in the time. I like to put in the effort. And essentially what happens is this is a very rewarding game, okay? So, you know, years come and go, and, you know, you feel such a good sense of self-worth when you start to see, okay, you know, my portfolio is kind of at a place where I want it. You know, my strategies and methodology, I do see developing over time. So for me, this really isn't an issue. And I'm guessing if you're on YouTube watching kind of these videos about finance and kind of DIY here, it's probably not much of an issue for you either. But I did want to include that, guys. And next up, this is probably the best point. Okay, so with something like SCHD, you know, if you get exposure to one bad stock out of the 103 holdings, and, they go bankrupt or they cut their dividend, essentially what's going to happen is SCHD is going to rotate that stock out of the portfolio, and as a shareholder, you might not even notice, okay? If you are picking stocks individually, kind of like I am, you're going to notice if you make kind of a bad pick, okay? So let's go ahead and talk about, my rebuttal there. And I want to pull up an example of what I would say. I'm not saying it's a bad stock, but for me personally, it was a bad pick. It wasn't one I did enough due diligence on. And that is going to be Target, guys. So, I built out kind of a small position in Target in 2022 on this dip, 21 shares. And, there was a lot of stuff coming out about Target. They were taking a lot of political stances. There was a lot of rumors about boycotting. First off, Target really doesn't have that wide moat that I typically look for. So I was already breaking kind of one of my golden rules. And I ended up, cutting the loss here let's see, I got in at 160, we'll call it. I got out at 130. So that's a $30 a share loss across 60 shares, guys. What's that come out to? $1,800. So I took an $1,800 lesson on Target. I would say that was a bad stock in my case, but for me, I do appreciate that as kind of a learning lesson. This was, I guess, kind of a pivotal moment for me where I was like, okay, I need to be more selective. I need to kind of get my criteria, on paper. I need to decide what I'm personally comfortable with. And while this was an $1,800 lesson, I do think the value of this lesson is going to make me, tenfold in the future. Okay, so that's my rebuttal there. I get it. One bad stock can suck, but it is a really good learning lesson, and Target is kind of my personal testimony on that. I know there is Target shareholders. I'm not really hating on the stock. I'm just saying, for my personal situation and my risk tolerance, I'm not a fan of Target anymore, and I did take kind of a $1,800 cut. But that happens, guys. That's part of this game. That is something I can live with. I understand, if you don't have the same risk tolerance as me, you really don't want to, put yourself out there. You really don't want to, take risk and potentially sacrifice some failure in order to kind of get ahead and develop your strategies. I do understand that, and that's kind of my take on why I don't buy SCHD, why I do this by myself. There's another YouTube channel called The Ryan Dangler Show, and he always calls it, he calls his style of investing real man's investing, which I think is pretty funny, but I think that's a good way to put it. Real man's investing, guys, is taking calculated risk, picking individual stocks that you see value in, and there is going to be times when you learn lessons, but my belief is it will definitely be worth it in the end, to go this route rather than just the ETF route. Okay, guys, does that make sense? Again, I'm Cashflow Cart. I upload videos every Monday night at 6 p.m., guys, and if you're new to this channel, feel free to hit that subscribe button. We are building the best dividend growth investing community on YouTube, guys. Thank you for all the support. It's been, it's been overwhelming, but I'm excited to keep taking this channel up, to keep working on my content, guys. Everyone have a great rest of your day, and I will catch you in a week.